Hello everyone and welcome. My name is Tim, trader at the Calm Compound, a company of professional traders where we show you exactly how, when, where and why we invest. And today it's time for a stock market analysis. So let's get right to it. In front of us we have the S&P 500, also known as the SPY in this case because it's the ETF version. And what we see right here is quite interesting because we have this W pattern that we've talked about before, where you see like the left part, the first dip, the middle resistance, and then the right dip, and now we're moving back up. In this, we are moving in a bearish channel. We've been talking about that for a while now. We broke out, we have confirmed, so there is a decent chance of us moving back up to 428. But if we look at the weekly chart, which is a very important one as well, we see that we are currently working on our 6th consecutive week up. So we've had 1, 2, 3, 4, 5, and now we're busy with 6. And you do see that the volume is also moving down. It's very light at the moment with only 2 days left to go. So that is less than ideal. Lower volume generally means there's less happening in the market and that there's less chances of things happening, although a bit more chance of manipulation. Especially in crypto, in stocks it's a bit less of a thing, but still we have to keep it in mind. Alright? Now, generally speaking, after 7 consecutive candles up, could be 6, could be 8, approximately 7, there is an increased chance of a dump back down. So what could happen in this case is that next week we see a pop up to the resistance that we see here, and then a crash back down, possibly back to this support area kind of right here, is what I would think would be most likely. It doesn't mean that that has to happen, but just know that from next week onwards, if we close this week green as well, there's a good chance that we will slowly start moving down, or counter trend anyway, even if it is just to kind of give the market a break, because 6 weeks consecutive growth is very hard to sustain. So keep that in mind. It's very important, and that gives some backdrop to the rest of the market. Even though it is earnings seasons, so keep that in mind. There's a lot of news coming very rapidly at you every day of earnings that are being posted, like Tesla, for instance, like that they didn't sell any Bitcoin. That has a lot of influence on what is actually happening with both Tesla as well as crypto, or with the broader tech market. All right, perfect. That is the S&P 500. If we move over to the triple Qs, you see that they are set to open lower today, but we have some time left. That could still change. And here we see on the weekly that it is actually doing fairly alright for itself. We had a nice move up. This is kind of like a flagpole, and then we have this move to the side right here. We can take this out actually. And we see that there is a little bit of a bull flag forming actually. It looks like this. It's not perfect, but it's pretty decent. And that was the wrong button. There we go. And we see that because of that, there's a decent chance of another move up. If we were to measure it out, we would say it's about this. Copy it, and then we say could even bring us all the way up to that 360 approximately, this previous high. But for that we have to break through this one and through the resistance trend line as well. So that is a bit tough, especially considering the broader economic situation. Credit market is still in a rough shape, and because if we think about, for instance, a banking crisis, right? It doesn't all happen in one day. You have like a slide, then some rest, then another slide, then some rest. We just had a slide. We are now in kind of a rest moment where the market is like, okay, if we don't slide any further, we should be good and we can continue on. So keep that in mind, that we have to be very wary and very watchful of news the coming weeks. Just like in the crypto sector last year, where we had like the first collapse and then sometime nothing, and then we had another collapse and then sometime nothing. So that is kind of what I'm wary of at the moment in the stock market, with the banks, with the inversion of the yield curve and all that kind of stuff. Generally, the inversion of the yield curve doesn't become an issue until it goes back up, but that is for a different moment. So that is the QQQ, decent chance of moving back up. Let's also have a look at the daily chart. This is the 3-day, but here you also see this flag quite nicely. And on the 1 day, it's not as pretty of a bull flag, so we can take it out. But we do now know that on the weekly there is a strong pattern that could lead us to break back up to at least this 333 for a test, and possibly further to the high before that around, well, let's say a bit under 360 to 375. That's kind of what we're looking at. With that in mind, we can also look at our other positions. But what I really do want to talk about is some commodities, because they're being very interesting. Gold, for instance, is at its major resistance point, which is good to see. This is a third tap, and repeat with me, on a third tap there's a 60% chance of it breaking through. We've talked about that quite a lot. Fourth goes up a little bit, or sorry, on the third tap 50%, on the fourth 60, otherwise it goes up too quickly, the percentage chance of it winning out. And then copper is not that interesting, but natural gas is slowly starting to catch a bit of a bid. We've made this double bottom right here, or the second low, with a divergence, and now we are finally catching some bids. We're moving back up, which is good for our positions in UNG and Boyle. Let's grab those as well. I think I have them here. Yes, UNG, Boyle I do not, but we do see that we are up a little bit. Had a bit of a slide yesterday, but it is still definitely an important one. And where's my price ranging tool? There we go. So we've had about 8% to 9%, and we are now around 4 or 5, which is decent. We still have a lot to go. There's an interesting gap right here, so we could move it all the way up to the 935. So that being said, for the rest, we have some interesting points going right now. Eli Lilly is doing perfectly, as although it did bounce a little bit off of this support here now, but that is not a problem. We could see a move back up for maybe a double top or a resistance coming in, but for now I am kind of looking at this gap right here around 354. That would bring us about 5%, and you know, that may sound quite low for the time that we're in it, but especially in these turbulent times, it's important to hit singles and doubles, meaning, you know, between 1 and 9%, or maybe 10-20%. But if you do that consistently enough, you will see that your portfolio grows really quickly. So having those small wins in a turbulent market is very, very important for you to be a disciplined and successful trader. Because once your portfolio grows big enough, that is perfectly fine. You can perfectly live off of that and have a very nice portfolio growth still. But in order to get there, you need to be as disciplined to really also tap out on those singles and doubles. Rack those wins up. I would much rather have a high percentage rate rate of wins than knocking one out of the park every so often, but also losing a decent part of your portfolio per trade. So keep that in mind. The steady way is to keep calm, keep cool, and keep compounding. And with that, I want to shut this video off, because that is about what I have to tell you for now. Keep an eye out for the earnings reports, and there is like a whole overview of who is reporting what and when, and I will see you all in the next one. Bye bye.